Welcome to a new deep dive. Today we're really digging into some fascinating sources about market dynamics. The title is Market Dynamics, Winners, Laggards, and Shifting Leadership.
Hmm.
Now, you probably see the S&P 500 making headlines, right? But our mission today is to cut through all that noise.
Yeah, get beneath the surface.
Exactly. Show you where the real stories are, the surprising facts, maybe some hidden shifts happening just below that main number. Okay, let's unpack this.
That's right. We'll be looking, beyond those headline figures to understand the powerful currents driving different sectors, different stocks.
Right.
It's really about spotting the patterns, connecting the dots, seeing why some parts of the market are thriving while others, well, lag behind.
And what that tells us about where the big institutional money is actually moving.
Precisely. That flow is key.
Okay, so we're going to look at everything from those big macro sector movements down to specific stocks, and even how everyday retail investors, like you, might be impacting things. Get ready for some aha moments, hopefully.
Super interesting.
So let's start with the big one, the S&P 500. The data shows it dropped, about 0.4% today, settling at 6,370.14.
Mm-hmm.
Now, that might sound like just a bit of a cool-off. I mean, it's still less than 2% below its all-time high. But what are we missing if we only look at that number?
Yeah, that's the crucial question. What's fascinating here is that the S&P 500's apparent stability, its resilience, it actually masks a much more dynamic story underneath.
Okay.
So despite some, macro headwinds, maybe some big investors trimming positions here and there, the real narrative is in the dispersion.
Dispersion, meaning?
Meaning wide variations. Really significant differences in how sectors and individual stocks are moving. It's not a uniform shift across the board.
Ah, I see.
So that overall index number, it's really just one piece of a much larger, much more complex puzzle.
That resilience is intriguing then. So if we peel back that layer, what's the first major shift jumping out? Which sectors are truly punching above their weight right now?
Well, our analysis clearly highlights two big winners, industrials and tech.
Okay, industrials first. Why are they doing so well?
Industrials are really thriving. They're benefiting significantly from policy tailwinds.
Policy, like what?
Things like R&D expensing that lets companies write off research costs immediately, and bonus depreciation, which is about faster tax write-offs for new equipment.
Ah, okay.
Morgan Stanley's latest call was actually spot on about this impact. These aren't just, obscure tax things. They create really powerful financial incentives for companies to invest.
Which directly boosts industrial profits.
Exactly. Drives that sector strength.
And I saw Capital Economics flagged something interesting. Cyclicals outperforming defensives. That seems rare.
It is relatively rare. Cyclicals, industries sensitive to economic ups and downs like manufacturing usually lag when things are uncertain. Defensives, like utilities, are meant to be stable.
Right.
But we saw cyclicals outperform last week, and that pattern is actually repeating today in the sector flows.
So why are cyclicals doing so well now? Seems counterintuitive.
That's a great question. It really speaks to a sort of nuanced optimism in certain parts of the market. Maybe they're anticipating a more robust economic rebound than some folks expect. It's definitely something to watch.
Interesting. Okay, and then there's tech and AI.
Ah, yes, the big one. Even with some profit-taking today, a bit of selling, tech is still an undeniable force.
Oh, so?
Our research shows this AI tech diffusion.
Diffusion.
Yeah, meaning AI isn't just in a few places anymore. It's spreading out, becoming integrated across more companies, more industries, and that continues to drive the index strength.
Get this stat. 5 giants, NVIDIA, Microsoft, Meta, Broadcom, and Palantir, they accounted for a jaw-dropping 56% of the S&P's entire gain so far this year.
Wow, 56%.
That kind of concentration. It makes you wonder about the market's overall stability, doesn't it? Is that healthy? Or is it a major risk?
It's absolutely a critical vulnerability. I mean, think about it. This isn't just some quirky stat.
Right.
It means the whole market's performance is disproportionately tied to how just a handful of companies are doing.
So if one or two stumble?
The ripple effect could be huge, much more significant than you'd see in a broader rally. It makes that S&P 500 stability look, well, maybe quite fragile underneath. And to really see this variance, let's look at a couple of specific stocks from today. They offer a glimpse into these tactical plays people are making.
Okay.
Take Merck, ticker MRK. It was up 1.7% today, which sounds okay, but it's still trailing badly year to date. So that jump today, it suggests more of a defensive bounce. Investors may be looking for temporary safety. Even in stocks that have struggled overall, It's tactical.
Okay, not necessarily a fundamental turnaround signal.
Probably not. Then look at Newmont Corporation, NEM, gold miner, up 1.6% today, and it's got a strong 35.9% one-year total return.
Gold strength.
Exactly. It reflects strength in gold, which is often that risk-off play, right? Investors move there when they're feeling uncertain about the broader market.
Yeah, these examples really do show how much tactical movement, how much variation there is under that main index number, even just day to day. Okay, so that's a pretty clear picture of strength in some areas.
Yeah.
But every market has its counterpoints, right?
Yeah.
What are the sources telling us about the areas struggling? The ones feeling the pinch?
Yeah, definitely laggards, too. Our sources point directly to consumer discretionary and staples.
Consumer discretionary, why them?
Well, Morgan Stanley remains underweight on that sector, meaning they advise holding less of it, and for good reason.
Which is?
The sector's feeling the pressure as retail demand seems to be cooling off. Plus, you've had significant money from recent IPOs rotating elsewhere. It shows a broader shift in investor sentiment away from these consumer-facing businesses.
Okay. And staples. I usually think of those as the safe haven defensive names.
You'd think so,
Yeah.
but they actually underperformed today. McCormick, MKC, the spice company, it fell 1.7%. That underlines this lack of traditional safe haven buying right now.
So for someone listening who typically seeks stability in those safe haven names, what's the new calculation? If even staples are underperforming, what does that signal?
It's a really important point. If you connect this to the bigger picture, it suggests investors are perhaps shifting away from those traditional defensive plays, maybe into more cyclical and value-oriented assets. It feels like a reevaluation of what constitutes safety or opportunity in this specific climate.
Interesting.
Let's look at a couple more specifics on the laggard side.
Okay.
McCormick, MKC, we mentioned it fell 1.7% today. It also has a negative 9.2% one-year return. So that confirms it's a defensive name that's just, well, currently out of favor. Reflects that broader shift.
Right.
And then Humana, HUM, the healthcare company, was actually up 1.5% today.
Always a but.
Yeah, but it's still lagging significantly year to date. So it suggests maybe a bit of a healthcare bounce, but one that hasn't fully recovered. It shows even within healthcare, which is often seen as defensive, not all segments are moving together.
These details really do highlight the nuances, don't they? It's
Yeah.
not just simple winner and laggard buckets. Lots going on within them.
Exactly.
Sure.
Very granular.
Okay, so beyond sectors and stocks, what about the money flow? Where's the big money institutional retail actually going? What do the sources say?
The money flows, always revealing institutional flows are particularly telling right now.
How so?
Well, one report from Bank of America, I believe, noted a near-record $4.3 billion poured into single stocks just last week, and another $1.6 billion into ETFs. Big numbers.
Wow, where did it go?
Led by tech, financials, and consumer cyclicals. But what's intriguing is this.
Go on.
Industrials actually saw the largest outflows in the previous period, but today they bounced.
So that suggests tactical buying,
Yeah.
buying the dip.
Exactly. It raises an important question. Are these big players anticipating continued strength there? Or are they just jumping on short-term opportunities, maybe positioning for some upcoming volatility? Hard to say for sure.
And it's not just the institutions, right? What about retail investors?
No, definitely not. The analysis shows private clients, everyday retail investors, like many listening, have been net buyers for 33 of the past 35 weeks.
33 out of 35. That's consistent buying.
Very consistent. And their support seems to be broadening out. It's not just focused on those mega cap tech names anymore, but also includes blue chips.
That's actually a really significant piece of info. Shows widespread market participation.
It does. This broad retail support definitely provides a sort of foundational layer for the market. However,
Always a however.
we also need to consider the broader macro picture and, importantly, seasonal dynamics.
Seasonality. Like what?
Our sources specifically highlight some profit-taking ahead of September. Apparently, big investors were noted selling positions around August 19th,
Why?
anticipating the usual September swoon.
The September effect. Explain that quickly.
Yeah, it's just a historical pattern. Doesn't always happen, but often enough that people watch for it. The S&P 500 tends to peak around, say, September 3rd, and then often experiences a bit of a downturn through the month.
So there's a historical pattern investors are actively anticipating positioning for. Okay. Given that, how does the huge AI concentration we talked about factor into this prediction? Does it make that September risk worse? Or maybe change the usual dynamics?
That's a critical point to connect. Our sources explicitly warn that if that enthusiasm for AI starts to fade, even a little,
Oh,
the S&P 500 could face a major headwind, especially given how concentrated it is in just those few tech names.
right. That vulnerability again.
It makes the market's reliance on just a few strong performers a really significant vulnerability, particularly if those seasonal patterns do play out like they often do.
Like one superstar player carrying the whole team.
Yeah.
Impressive when they're scoring.
Exactly. But what happens if they have an off night
Hmm.
or get injured? The whole team suffers disproportionately.
Okay, so pulling this all together,
Mm-hmm.
what does this all mean for you listening?
Mm.
This deep dive, I think, shows us that while that main S&P 500 index number might look pretty stable, maybe even boring on some days, its resilience really masks a market where leadership is, well, two things at once.
Yeah.
It's remarkably narrow, really heavily reliant on AI and those mega cap tech stocks,
Very narrow.
and it's rapidly shifting, with other sectors like industrials, even things like gold miners, starting to come into play more tactically.
Exactly right. Those sector rotations are clearly picking up speed, and you can see tactical investors are actively preparing, positioning themselves for that typical September volatility.
Yeah.
The real action, the real outperformance, isn't just in that headline index number everyone quotes. It's in the constant churn happening beneath the surface.
Understanding these movements, then, the winners, the laggards, where the money's flowing, that seems key.
It's absolutely key to being truly well-informed, and maybe even to anticipating what might come next.
Okay, so this leads us to a final thought for you to consider as we wrap up. How might understanding these specific sector rotations, the impact of things like policy tailwinds we discussed, and those historical seasonal patterns, how might that change how you view the daily market news?
Or even how you approach your own research.
Right. What hidden patterns, what underlying shifts will you look for next time you see a big market headline? Something to think about.
Yeah.